Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Sunrun stock so we can determine if it's a buy or a sell. Sunrun generates revenue by selling solar panels to homeowners, but that is about half their revenue. The other half is kind of unique. What they do is they install and maintain a solar system on someone's home. Then they sell power to that customer at a rate they agree upon for 20 or 25 years. This allows the property owner to install solar with no upfront costs. But of course, they do not receive any tax benefits. The company has a sizable network of partners, including Costco and Home Depot. When I shop at Costco, I always see a representative from Sunrun trying to get my attention to sell me their service. The company is headquartered in San Francisco, California, and was founded in 2007. Let's get started with the model. This is a mid-cap company, 3.7 billion market cap. They're trading at $17 a share, and they have 215 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So their free cash flow looks awful. It goes from negative 1 billion to negative 2.9 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also looks really bad as well, from negative 390 million to negative 850 million. Revenue looks great. It grows from 859 million to 2.3 billion. Last week, they released their first quarter earnings. So their revenue in 1Q was 589 million, up from the same time frame in 2022 of 496 million. They generated 340 million of revenue from selling solar panels, and they generated 246 million from selling energy. This is the part of the business model where they install solar panels on someone's home for free, but charge them each month for energy. And here's a breakdown of all their operating expenses. They generated 246 million of revenue from the contracts to sell energy, and the expenses are 237 million. So they're really not making much money. It's kind of break even. They're also not making money on selling panels. They generated 340 million of revenue, 320 million of expenses. Plus they have marketing of 200 million. Then of course they have payroll and other administrative expenses, 52 million. So total expenses are a lot more than revenue. So they have an operating loss of 227 million. Then you have interest on your debt. They have a lot of debt. So they have a huge net loss every year. It's double last year. Last year they had a net loss of 156 million. This year it's 336 million. Let's look at the capital structure. 7 billion of equity, 9 billion of debt. They're 43% equity, 57% debt. Their net debt is 8 billion. So they have about 800 million of cash on their balance sheet. They have a pretty high WACC, 16%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 8.5 billion. We discounted those numbers back to today's and the weighted average cost of capital. We get a value of the company of $3.2 billion. We divide that by 215 million shares. And we get a calculated stock price of $15. They're trading at $17, so they're trading at a 16% premium. It's a sell according to the model. 12 analysts priced this stock, and the average price target is 32. The lowest 25, the highest 46. 26 more analysts priced this stock, and the average price target is 37. They say it's 114% undervalued. This is where the stock has been trading since it IPO'd in 2015. So it pretty much traded sideways for about 5 years. And then after the first quarter, there was a huge run-up. Most solar stocks did really well in the second, third, and fourth quarter of 2020. This ran up to about $95. And ever since that big run-up in the beginning of 2021, it's only gone down for the next 2+ years. There were some jumps right here, and right here, but overall, it's pretty much gone down. If you held the stock for 1 year, you would have lost money. Look how big these green and red lines are. Lots of trading activity. There are 20 companies in the same industry as Sunrun, and if Sunrun has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend more than anybody in CapEx, over $2 billion. Their debt to equity ratio is equal to the median, better than the average. I mean, look how leveraged these companies are. Array, Canadian Solar. Look at Maxion. I cap my debt to equity at 10, just so the average doesn't get too high. So their debt to equity is higher than 10. They lose the most money out of any company on this list. They rank 4th in market cap, pretty far behind the top 3. They have a really good price to book, probably because of all that debt they took on. We can't look at their PE or price to free cash flow. Their price to sales is equal to the median. They generate a good amount of revenue, and their 5-year annual revenue growth rate is 33%. There are 2 major ways to run a successful business: grow revenue and decrease or manage expenses. They're growing revenue, but their expenses are so much higher that they lose money year after year. You have to get profitable at some point. When I went to their website to get their first quarter income statement, the first thing that popped up was this. So I figured I'd talk about it. There are 4 options. You could purchase panels from them. The idea is you would pay them, say, $30,000, and they would buy the panels and pay for a crew to put it onto your home. Say the panels cost $15,000 and a crew costs $5,000. So it's a $20,000 expense to them. They charge you $30,000. They make $10,000. I'm just making up numbers, but that's the idea. Now you could get a loan through them, and they would make money on the interest rate of that loan. Or they may connect you with a bank. I'm not sure if they fund the loans themselves. Or you get the panels for free and buy the energy. You would pay a premium on the energy. You would pay a lot more than the people who bought the panels outright. So if you get free panels and you use $10 worth of energy in a month, they may charge you $40 a month. Where these people use $10 of energy, they pay $10. To summarize, this company's been around 16 years. They lose money year after year, but it is possible they do start to make lots of money as they get more and more people to sign long-term contracts with them. Or maybe the deeper a customer goes into a contract, the more margin Sunrun makes on them. I rank their free cash flows 1 out of 10, their revenue 8 out of 10, and their ratios 4 to 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you want to become a member, just click on the link in the description below. Thanks for watching.